Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF conference, and I'm here with Simeon Hyman, who's the head of investment strategy at ProShares. Simeon, great seeing you.
Thanks for having me.
Well, thanks for being here. There's a lot that's been going on in the market, and ProShares, again, one of the preeminent ETF providers as far as strategy. You guys have a lot of real strategic type ETFs that have taken advantage of some of the recent swings. First, let's talk about dividend growers. I mean, that's been one of the hottest areas in 2016.
It's been a really important area for us.
Yeah.
Our flagship ticker NOBL is over $2.5 billion. It's the S&P 500 Dividend Aristocrats, and it's a large cap dividend grower. But Tom, as many of the people watching this may not be aware of, the dividend growth strategy works very effectively in mid and small cap stocks as well.
Mid and small caps have kind of lagged for a long period of time, and then the election came and boom, small and mid took off. So give us a little bit more insight as far as diversification that advisors should be thinking about regarding mid and small.
You know, they are coming back. Of course, they should be part of an evergreen asset allocation, but in the near term, folks are talking about Trumponomics. You know, how can I have some domestically focused small and mid cap stocks that can take advantage of perhaps some reduced regulation, reduced taxes and fiscal stimulus, and maybe not exposed to some of that trade and international stuff. Right. So that's the impetus between small and mid. The dividend growth strategies, REGL is our mid cap, SMDV and small cap, are great ways to take advantage of that because they identify these quality companies, and as an added kicker, they also don't have some of the leverage you see in some of the smaller companies.
So if this pro-growth strategy continues, we're starting to see inflation kick in, we're seeing wage growth move, we're seeing commodity prices increase, it's going to force the Fed to again hike rates. Talk about your interest rate hedge strategies.
You know, on the interest rate hedge side, we are the leaders in a suite of bond funds that have built-in hedges to take them down to zero duration to eliminate interest rate risk. HYHG is our high yield fund and IGHG is investment grade. Of course they've done very well as rates have risen because they've protected you from that, but they're considerably more effective than say a short duration product which takes down your interest rate exposure and your credit exposure at the same time, and it leaves you with a little bit of both. Yeah. The more surgical answer is to keep all that credit exposure, just surgically hedge out the interest rate exposure, and that's what we do with HYHG and IGHG.
So keep the yield, shorten the duration.
You got it.
Great, excellent. Simeon, as always, I always learn something. Thanks so much.
Thanks so much.